Our next guest says new highs often make room for new highs. Instead of selling in May and going away, he says maybe buy in May and enjoy the day. He's riding the wave higher. He's Brian Jacobson, chief economist with Annex Wealth Management. Brian, always good to see you. So you think that there is more money to be made in this market, even if you don't add money to your position?
That's right. Yeah, thanks for having me. Yeah, here at Annex, the way that we're looking at it on our investment committee is that earnings expectations continue to rise. And so that is actually something that seasonally speaking, back in April, earnings expectations typically fall, but they actually began to rise. And we think that that's actually just showing that the sell side maybe has still been a little bit too negative on the broader market. And so we could see some continuation of this rally. I know the old maximum is, sell in May and go away, but it really doesn't pay off in the near term or even over the longer term. If you think about what we are likely to encounter over the next few months, pretty decent economic data, the Fed probably still saying that they're in this pause. Really, we just need to wait for the earnings magic to work itself.
I'm going to ask a question that may be a little off point. I was having a conversation with a viewer earlier today who pointed out that when the 2017 tax cuts came in, basically, there was a 40% reduction in the corporate tax, the highest marginal corporate tax rate. And profits have risen now by well over 40% since those tax cuts came into play. How much credit do the tax cuts deserve for helping lift this market to where it is today?
That's an interesting question. We've looked at some of the data as far as the effect that the tax rate has on earnings growth, and it's really a mixed picture, as you would expect. There isn't really a definitive answer. It is nice that corporations are able to pass on more income to shareholders. They're able to reinvest for growth as opposed to necessarily paying the government's bills. But the tax cuts themselves, there's all sorts of hand-wringing over who was that going to really benefit, especially since bigger companies are pretty adept at not paying taxes, through legal means, of course. I don't want to make any accusations, but they are adaptable organizations. And it's oftentimes the smaller cap stocks, they're the ones who foot more of the tax bill. And there are the earnings growth that you really haven't seen participate as much as the big companies who have been pretty good at keeping their effective tax rates low.
Brian, you mentioned something that is getting a little more attention. Brian Reynolds, another Brian always focuses on it as well, but he and you both think that buybacks are going to increasingly be an important component of this rally, and this takes us back to kind of the late 2010s when this was a huge phenomenon. Just talk a little bit more about that.
Yeah, we do think that, you saw Apple and Google announce big buybacks. They have a lot of cash flow, so why not? But other companies are likely to get into that game as well. If they have already termed out their debt, you have seen some that are paying off the higher cost debt because of the cash flow. So maybe there isn't this massive refinancing wall that's looming in front of us. And with the excess cash, they're probably going to be able to deploy that as far as with buybacks and also with the dividends. Now, big companies, they do have to pay a little bit of a penalty to the government if they do those buybacks. We thought that might tilt things a bit more in favor of dividends as opposed to buybacks, but it's not punitive enough to really incentivize them to stop doing these buybacks. So as long as we're seeing earnings expectations rise, buyback season is really coming into bloom, we think that that's really a formula for the market to continue to move higher.